see us live?
So tell everybody to go to the right channel.
Oh, it's a different one now?
You're live now.
I'm live now in a different view or this current one?
Right here.
I know, but is it though in the Don, you don't see us live?
Hey everybody, give us one moment. You're doing great.
Oh, wonderful.
I love it. Okay. Hi everybody. I don't need a microphone. Tim is filming right now, and we're super excited to have you. Listen, we wanted to get this done. We scheduled it at 1. We had the spinning wheel of death on YouTube. We could not figure this out, but we're here now. We wanted to bring you this content. What's he saying?
He can't do chat, he can't control anything.
That's okay. That's okay.
Alright, we're just live at least right now.
Llewellyn said he's moved over to
Can
here.
people
We'll just
comment
do
at all or no?
interactive.
Okay, great.
I'm seeing comments come, yeah. Llewellyn.
Well,
Yep.
I can't see, but I'll try on my phone.
Alright, cool, bye.
Thanks,
Yep.
guys. All right, we're gonna go for it. Paul, let's go for it. People can jump over. We appreciate your patience. You guys are incredible, and we're getting
I'll
this
bring the
done.
people over, Llewellyn.
great.
We're gonna give some moment for everyone to
So
jump
wait a
in.
second, time out. Is it a new chat?
Yeah, it's a new
Yeah.
channel.
Okay,
New
that's what I
chat.
asked you guys and
Sorry.
that's
Yeah.
okay.
Sorry. You guys are doing great. We are going to analyze some amazing stocks today. Many people have asked about CVS, Target. We've had some Walgreens requests, and someone said Home Depot. So we are going to get this done. And Paul, your mouse is frozen.
My mouse is frozen.
Yeah, try that real quick.
Can we have any more technical difficulties today?
Can we have some, I'm at like
So-
60%, but should we get somebody down here with a power bank?
We won't be able to go that far.
Okay, well, we'll go as far as we can. So talk to the people, Seth. You got a few people on?
Oh, thanks. Who is on, Tim?
Let's see. Oops. I don't know if I can see who's on. There's
Okay.
about 7.
Oh, maybe I can.
Vinny's on.
Oh,
Vaughn's
Vinny.
on.
Vinny, you're from. Vinny's from where? Dubai, overseas. He's from somewhere. He's out there. What we're gonna do today, guys, is not.
Now, this is podcasting, David said.
Okay. This is run and gun cell phone podcasting. You're still gonna get the amazing coverage from Paul. Look at that, Paul. Isn't that funny?
What's funny?
Oh, the mouse. Let's do it. I'll try and get it up on my phone.
Yeah, you should be able to get on your phone to
Okay,
monitor
okay.
chat.
Paul, let's get after it.
Is everybody going to the other YouTube? How many people we have?
Yeah, Llewellyn said they're bringing it. 8 people so far. He said, I'm bringing them over.
Okay, we'll give them a minute or two to get on.
Yeah.
Good.
In the meantime, guys, actually, we have a special consultant on today. Now, he comes highly recommended from the stock market industry. I probably guarantee that he's done more stock analysis than you have as a viewer this week. I'm not judging anybody, but we could all work a little bit better. So I'd like to introduce, he's 10 years old, and his name is Gio Kirchanen.
Hello.
Gio is my son. Say hi to the fans, G.
Hi.
Now you're here today, why, Gio?
To analyze these stocks with you guys.
Now show him your notes here on CVS and Target, and talk about what you did here to get ready for today's
so
show.
what I did was I sat down and I made this whole entire I made a list kind of. I
Show
made
the fans your list. So
Sections of things and the different sections of market cap, price, profit margin, and PE ratio.
now, Paul, tell us why you wanted this guest on. You didn't, because I brought him on myself.
Yeah, I walked in and I'm like, Gio's here. He's like, yeah, you're a consultant. I'm like, great, let's do it.
So in the meantime, guys, let's do this. Paul, while we're starting, people have been asking for CVS for a long time. Paul's gonna jump right into it right now with the 8 pillars of looking at a stock. As always, we thank you so much for staying with us. Please smash that like button and subscribe, Gio says. And we will get commentary from myself, from Gio's stance on this, and Paul. Paul, tell us about CVS. Why are so many people drawn to this company?
Okay, so we're going to go through the 8 pillars, right, Seth?
Yes, pillar number 1.
So CVS, first off,
Go ahead.
10,000 retail pharmacy locations primarily in the United States. That's a huge number, right? I mean, they talk about, I think the CVS is well known, they talk about like if you get a piece of land in a corner, in a good corner, that could be worth over $1 million just for the land for CVS. Now I think that's an exaggerated number, it's probably higher actually. But PE, off the dribble, 9.4. That's pretty incredible. So remember, people, their market cap is $77 billion. We don't care about their actual stock price. But the PE is 9.4, so already a check mark there. What's next, Uncle Seth? Profit margin. right?
Profit margin number 2. Pillar number 2 is profit margin.
Okay, this one's an X, 4.5%. But in the retail world, this makes sense. They're going for volume. They're trying to get as much volume as possible to get profit in. Just like Walmart, just like Amazon, those guys do not have big profit margins. So far we have one check and one X, correct?
Yep, pillar number 3 is revenue growth.
Revenue growth. So let's go to financial statements. Let's go to annual. Let's go to revenue. Okay. You're awfully close, Tim. Is that okay?
Oh, it looks great, Paul.
Is it? Did
Yeah,
it?
they
Okay.
love it. People love it.
All right, ready? So 153, 177, 185, 195, 256. Check mark. But I want to have a caveat in here. The caveat is it's very difficult for a company this big to grow this much. There has to be some other things involved, like they were making acquisitions along the way. Something was happening because for a company that's $150 billion to grow, 66% in a matter of 5 years, actually 4 years, that's kind of a hard thing to do. So we'll see. But either way, it's not. It's still a check mark.
How about pillar number 4? We did profit growth. Yes, profit growth, Paul.
Okay. So 5 years ago, 5.2, 5.3, 6.6. They lost 594, 6.6. Check mark there. Whenever you see a big drop, a big aberration in profit or revenue, something's happened. I'm willing to bet a lot of money there was some big write-off here, somewhere in the financial statements where they wrote off some big asset they had, maybe an acquisition. One time, if you see in the past here, Tim, going back the previous 5 years, there was steady growth along the way for profit. So check mark here.
Paul, they're saying that they can see the pores in your face and the bulge in your pants. So
Hey, can we show my shorts off?
keep up the great comment. Oh yeah, look at these shorts today.
We gotta watch the shorts.
These are very short.
Bamboo Avenue. I've got 4 of these, different colors, showing off the shorts. Okay.
3 check marks so far and 1 X so far.
Oh,
Exactly.
Thank you,
Thank you, Gio.
Pillar number 5 is number of shares outstanding. We want this decreasing, Paul.
So we're going back only 5 years now. That was our decision. In the last podcast, I was going to go back 5 years. 1.118, 1.073, 1.02, 1.044, 1.3x. So in the last 5 years, their shares outstanding have been increasing overall. So that's an X there.
X on shares.
X on shares.
Current assets greater than current liabilities.
What is your guess on this one, Uncle Seth?
I would think since they have a lot of stuff sitting on their shelves, they're probably underwater, Paul.
So a lot of stuff on their shelves would actually be considered a current asset.
Oh.
Yeah, because it's inventory. So a current asset is technically anything that can be converted to cash very quickly.
Okay. keep
All
going.
right. So their total current assets are 62.5 billion, and their total current liabilities are 63.6. So a slight off. It is still an X either way.
How about free cash flow? Pillar number 7. We
Okay,
want
free
cash
cash.
from operations versus capital
And I
expenditures.
want to thank somebody who caught me on a mistake. I was looking at debt before on Cisco. The Cisco free cash flow is actually incredible. So here's what we have. Cash from operations less capital expenditures. So here we have 6.2, 7.9, 6.1, 6.8, 10.4. So check mark here. And the average is 14.1, 20.2, 27, 37, 34, 35.1. So average divided by 5 equals 7 times 20 equals 140 billion. So we want this company to be worth under 140 billion.
Gio, what's the market cap on this?
Market cap is 74 billion.
77 actually right now. So guys, I like this.
Paul.
This is a good one.
Gio, how many checks and X's do we have?
We have 4 checks and 3 X's.
Actually, we have 5 checks now because free cash flow on
Correct. So we currently have 5 checks, 3 X's, but the biggest factor for me is probably that price of free cash flow. It is selling for about 10 times the average of the last 5 years price of free cash flow. So to me, if you need to make a decision today, I don't think you can go wrong buying them. They also pay a 3.4% dividend. That's a nice little check mark. it'd be very, very difficult to take over CVS. They have physical locations. It's going to be very. Now, I would argue that Amazon's probably the one that could probably do it by doing, drone deliveries and all that stuff.
Yep.
But I'm willing to bet a lot of money that CVS will probably have the same thing happen to them along the way.
So we just had a user say they bought Aetna.
Yeah, they
and
bought
they're
it.
in.
That's probably my.
Thank you.
Yeah.
So why did they buy Aetna? Aetna's healthcare, close to the healthcare business. Hell, you know what could happen? Amazon could very well buy CVS someday, right? Wouldn't that make sense?
Ooh,
Yeah.
CVS is in Target stores too, Matt Jensen said.
What was that?
CVS is in Target
Oh,
stores
are they
too.
really?
That's right.
Oh, Matt coming in with the Minnesota pride.
So what's the take home to the viewers, Paul? What do you think?
I like it. I like the stock.
Wait a minute, hold on a second now. Going back, again, Paul, I have to cut you off. As a normal person, what about the price?
So the price, like I said, is selling for 9.4 times PE, 10 times free
I
cash
mean the
flow.
price of this stock.
Oh, who the fuck cares? What is the price of the stock? $59. Okay. I don't care what the price of the stock is. I care what the company's
So
price
you don't
is.
look at this
No.
downtrend and
Oh, so now you want to talk about the trending stuff.
momentum, yes.
Momentum, thank you, a little bit different. So let's go to technicals page. We're gonna go to 50 and 200 day. Now guys, if you look here, around April, it crossed below the 200 day, which is a negative sign. It's still about the same level as it was there. So there's a little bit of negative momentum potentially, but this 200 day average is coming down. So all it needs is a little pickup and they might be coming back. So who knows? If you're trading this thing, you might want to hold off. If you're buying up from value, start building your position.
Very nice.
Potentially.
Let's switch over to Target right now while Paul pulls it up. Gio, what is the market cap for Target?
So Target's market cap is 82 billion.
82.
By the way, we're going to make note that Gio is not in school right now because he's learning more important things right now than schoolwork.
And pillar number one, what is the PE ratio for Target?
I feel like we're on the Blair Witch Project.
I know, go ahead.
So funny enough about the market cap, 50 billion of the market cap is just for my grandma. So
I was like, what are you talking about?
Pillar number one, PE ratio. Gio, we want this under 15 or 20, I'm sorry. What is it, Gio?
the PE ratio is 23.
Okay, the P ratio is 23.7. The market cap is 82. Remember, everybody, market cap is actually the price of the company. Don't care about stock price right now, but it's selling for 23.7 times earnings. I don't like that. That's an X.
Pillar number two is profit margin over the profit margin percentage.
Another X, 7.4%. In the trailing 12 months, it was about the same thing.
Now, Paul, compared to other retailers, aren't you kind of happy with 7? Because a lot
Yeah,
of places
7's not
have
bad.
4.
Yeah, 7's not bad. And so Target versus Walmart, for example. Walmart's consistently in 4 or 5%. And we're going to look at Walmart shortly. I don't know the exact number what it's at, profit margin wise, but historical.
Profit margin wise, it's at 4.7.
For Walmart?
Yeah.
My dude. So it's better than Walmart. They're also
Still
paying
an
a
X?
Yeah, it's still an X though, but they're also paying a 1.6% dividend. But this is why the checks and X's don't apply unilaterally. You have to look at every situation differently. In the last example, we had 5 checks, 3 X's, and I very quickly said I'm probably a buyer of a CVS at that point. So
Revenue growth over the past 5 years, Paul, pillar number 3.
So Target, I don't think it does any acquisitions, or very few of them. So I imagine this is going to be a lot of organic growth. And I think it shows in the revenue. 73.8, 69.4, 71.8, 74.4, 77.13. Check mark there. So they have revenue growth. And advice for a company like Target, it's not going to be big revenue growth. It's going to be a slow trudge. Look, 10 years ago, they did 67 billion. They went up, they went back down, they went back up again.
Profit growth over the last 5 years, profit growth.
3.3, 2.7, 2.9, 2.9, 3.2. X actually. Technically it's an X, guys. Technically it's an X. Unfortunately, but that's okay. Again, it's an X, but it's not terrible.
How about shares outstanding? We want this going down.
627, 577, 546, 528, 510.
You gotta
Big
love
fat
that.
checkity check.
Yeah. How about current assets greater than current liabilities, pillar number 6? Keep it up, guys. You're doing great.
Okay, we have total current assets of 17.6 billion. Total current liabilities of 15.89. So what does that give us? A check,
Big check for
right? Is
assets.
that, yeah, exactly,
Yep.
correctly.
Great. How
Cash
about
flow.
free cash flow growth?
Okay, so annual free cash flow growth. Remember, guys, cash from operations less capital expenditures. So 4.5, a 3.9, a 4.4, 2.4, 4.1. This is an X.
Uh-oh.
It's very consistent, and by the way, that's consistent with the profit number. It's up and down with a very consistent straight line. So it's good that this is consistent with the profit number. It shows that there's probably less hanky-panky going on. Even though it's an X, again, this is a very slow-moving company, so growing company, it's not gonna be sexy. I'm expecting this from there, and I'm okay with this. Now, the average is 8.4, 12.8, 15.2, 19.3 divided by 4 is, divided by 5, 19.3 divided by 5 is 3.8 times 20 equals 76 billion. $76 billion we want to pay, guys, and what's it selling for right now?
Gio?
87 billion? You don't know, I don't think. 82 billion.
82.
Guys, this is very, very close. So, here's a prime example. Here's a prime example of how I get back.
Paul, someone said, Dave said Target tried to expand into Canada and lost money and ended up closing all of its Canadian stores. I didn't hear about that.
I didn't hear that either, but really quick, Dave, before we go further than that, I said I want to pay less than 76. It's at 82 billion. So it's very, very close from the standpoint of where I'd want to be looking at. So from a price standpoint, you might want to wait for this to go below 150 before you start looking at it. Don't buy immediately 150. It's still a little pricey there. But Target's not, probably it's going to be very hard for Target to go anywhere. Do more research on their debt. Make sure their debt's not overwhelming. Retail is changing, folks. You got to make sure Target is ready for the next retail experience, which is going to be more remote and more delivery. So back to the, they try to expand into Canada. I did not hear that. Those Canadians hate us.
Yeah, we had a great comment. Someone said we should have tiers of our X's. If there's different levels, sometimes you're like an equal sign, Paul. Sometimes you're like a heavy X, a low X. So, but I do think Target is just, there's that running joke that women walk into Target and just walk out with carts.
And I think we're reconnected now.
We're gonna pull up Walmart right now, Paul. Walmart's market cap. Gio, what is Walmart's market cap?
Walmart's market cap 409 billion.
So Paul, versus Target at 82. This is 400 billion for Walmart. They're everywhere. I feel like, comment below, don't you guys feel like Target is some sort of like a little more luxurious than
Yes.
Walmart? And I don't know how they did that with their branding and the cleanliness of it.
Yeah.
But
It just
Look at
looks
this way.
You
clean.
go to
Yeah.
Walmart and you can't find anything you want. Like you go to Target, you can find.
You can find anything you want at Walmart.
Well,
What can't you find at Walmart?
It takes you longer.
Because it's bigger.
Yeah.
Walmart has 11,500 stores, guys. It has more locations than CVS. And we all know how much bigger Walmart is than CVS, their actual physical locations. This thing is ginormous. So, Walmart, $400 billion company. PE, 23. Pretty much the same as Target.
Yeah. Same as Target.
Okay, profit margin, 4.7%. So we have X's on both of these. But again, for everybody out there, these are not big X's. This is retail. It's just not, remember, to everybody who's sitting there saying, well, we should have different levels. You're right. These pillars, whenever I look at them, isn't a tried and true reason to buy or not buy a stock. It's about looking at the whole picture together. You guys see me, price to free cash flow, if it's high, if the ratio is high, I'm pretty much avoiding it. If it's low, that's the most important one to me. The profit ratio and the price to free cash flow. So we have two X's to start.
revenue growth?
Revenue growth.
Revenue growth over the past 5 years. Guys, thanks for following along with us. I know we had a choppy feed. Smash that like button. We really appreciate your support. Our subscribers are gaining every single day. And Paul and I,
We gained 50 subscribers yesterday.
we are
We
crazy.
need the 2,000 subscriber. We need this 2,000 subscribers.
We are,
Should we explain this?
I mean, Paul, go into it.
Well, I
Because,
think you should explain it.
what's that?
The Patreon?
Okay, listen. Guys, I've been begging Paul for a while that if you guys want more access to this mind, I have the I'm just very lucky to have this guy in my life. I literally call
I
him.
pay you.
Yeah, he pays me. He pays me so that I can call him and learn all this stuff. But I told him we should think about doing a Patreon to get more access to this guy's mind and more exclusive access with
And
you.
what did I say at first?
And he said, absolutely not. We don't want to beg for money. We don't need money. We don't need any of that. I keep saying it's not about the money. It's about just a more personal access and
And then can I
interaction
now?
with Paul. Go ahead, Paul.
So then I texted Seth and I said, Seth, if we can give them more value, I want to do it. So here's what we decided. We're going to come out with this Patreon. You guys have heard about me creating this app. What I want to do is for the first 10,000 subscribers, have this, until we get 10,000 subscribers, it's going to be open. We don't know when we're starting. It could be next week, it could be the week after. We're going to have different levels. I'm going to give you guys lifetime discounts and in some levels, lifetime free access to the app. Because we're going to charge for the app, but I know everybody who's helped us out from the beginning, I want to make sure, like with Dynasty on our fantasy football game, we had beta testers. So basically you guys are going to be the beta testers, help us out. And for the lifetime, this app is going to do all the pillars. It's going to give you the Y charts kind of data feed in there so you can look at the data for free, not for free, but from the app. And just basically a way for me to give more support to Don, Tim, and Seth financially. And it's providing access, more live streams that are more exclusive, less people. That way you guys can ask more direct questions. And in some situations, even get one-on-one with me to talk about your investments and things like that. So keep on the lookout for that. We're gonna be doing that because I wanna have the app come out within the next 6 to 12 months. And this is a way for you guys to get it early on, not have to worry about paying $20 a month, whatever we charge for it, because we wanna make it a very exclusive app.
Let's go to revenue growth for Walmart over the past 5 years.
All right, revenue growth. Okay, 482, 485, 500, 514, 524. Check mark there. Keep in mind with Walmart though, guys, they are opening new locations worldwide. So a lot of this growth is probably not organic, as they say, which means same store sales. One of the most important factors, I should have mentioned this before, in all retail is look at same store sales. What that means is they're gonna look at the sales this year versus last year only on stores that existed at that point last year. So anything new wouldn't have been counted. And the reason that's important is you want to see what the stores that have been around for more than a year are doing today. If you don't see growth in there, if you see a drop, they're just growing because they're adding more stores. That's not a good long-term solution. That's basically like, what's an example of that? That's basically like you make $80,000 in a year, but you're spending 90, but you figure out other ways to keep adding more. That's not the proper analogy. The bottom line is same-store sales matter a lot.
How about shares decreasing?
Well, we haven't done profit yet.
Oh, profit growth. Sorry, profit growth.
Okay.
That was revenue.
Yes, profit growth. 14.7, 13.6, 9.86, 6.6, 14.9. Technically a check mark. I don't like these two dips. Probably something happened in there. They probably wrote something off. It's a very typical thing. Right here, there's two write-offs right here, $8.3 billion and $3 billion. You want to understand what that is. So, it is still a check mark, technically, but it wasn't exactly the best, but it's what is expected from Walmart. They're not going to have big growth. Shares outstanding, 3.2, 3.1, 3, 2.9, 2.85. Chickadee check.
Current assets greater than current liabilities.
This is probably going to be very similar to Target, as they say. Total current assets, $65 billion in the nose. Current liabilities, ooh, $82 billion. So this is a mother of an X. This is an X, guys. So they don't have enough inventory and cash to pay off their current debts.
We're at 3 checks and 3 X's.
3 checks and 3 X's. We have 2 more. The most important ones, in my opinion.
Free cash flow growth.
Free cash flow and free cash flow growth and free cash flow ratio. These are the 2 most important to me. I do like these the most. I want to see, are they doing a good job of increasing their free cash? Free cash is how you pay your investors back, how you do other things in the business, make acquisitions, etc. So here, 16.1, 21, 18.3, 17.4, 14.5. So this is an X, guys. It's actually pretty consistently going down. I don't like that very much. This is an apprehensive level for me. Why is it going down? This is where your research matters. You need to go research why is their free cash flow decreasing as their sales are increasing. Their sales are up $30, $40 billion, their free cash flow is down. What's the average here? 37, 55, 72, 86 divided by 5 equals 18, 19, no, sorry, I was right, 18.2 times 20 equals $364 billion.
Market cap?
And the market cap is 400 and some.
409.
Yeah, 409.
Okay, so they're only paying a 1.5% dividend. Even if they drop to the price you'd want them at, so we want them to drop about 12%. So 12% on $15 is $18. So even if it fell to like 125, let's say, which is the price I start looking at, I'd still be apprehensive because I want to look at that free cash flow number. But 125 seems to be, if they were able to stabilize their free cash flow and get back to regular growth, I'd be buying at 125 and I can expect to do pretty well with the market. But for a company like this big, that's fine. I just don't get why their free cash flow is decreasing. That's a big red flag to me. Now, technicals. Let's go to the momentum stuff. Let's see how they're doing there. Okay, guys. So, back in April, they crossed. Ooh, look at this. They're going up. You'd have bought here, which is roughly 120, 115. You'd have made about 20% of your money if you'd bought at that price where it crossed over. So it has some positive momentum now. You can see the gap between these two is increasing. So it's really increased over the last few weeks, few months. So it has definitely positive momentum here right now.
Laren's asking, do you ever go risk off with purchasing new stocks when the overall market looks overbought, or do you just focus on individual valuation?
That is an excellent, excellent question. I battle with this one. This is a hard one because I don't mind. Right now I have stocks that I buy individually, and I have bought individually. I'm not buying big chunks of them, but I'm starting to build my position as it grows. Whenever the market's going to have a big sell-off because everything's so expensive, it's always scary to do that. The guy who taught me value investing, he does not care where the market is. He looks for good deals, and the good deals, because if you look at history, when markets are bad, these value stocks that are selling cheap can go up. So even in a down market, they can still go up. So it's an excellent, excellent question. What you should worry about is the individual company and buying good companies at good prices, and realize that if the market sells off, you're probably going to go lower, and you should buy more of that company. If you're okay with that, other than that, you're just timing the market. I'm still buying stocks today, not a lot, and very specific ones, and I'm also what's calling selling puts on them so I can buy them at lower prices and generate income. But that's my other questions.
Yeah, Type Def says, thanks for joining late. It's okay. Our app is going to be an 8-pillar stock screener for sure, and more. And yes, Paul is using Y charts at the moment, but you can figure all this out using Yahoo Finance or something of that nature.
And the app will allow for you to see all this data that we're giving you, except for, well, the charts might be hard for now, but all the other data, it'll be like the financial statements, it'll all be in the app as well. So you can look at the data yourself.
Paul, let's finish up with Home Depot.
I love Home Depot.
We were going to do Walgreens. I just don't think it's as sexy as Home Depot. I go to Home Depot like 3 times a week.
Are we gonna go longer because we started late, or maybe a few minutes longer?
Maybe. I have a 2 o'clock.
Oh, you do? Well, I could always do some stuff.
Okay, I mean, I guess you could.
Paul.
Okay, the 2 of you?
All right, Home Depot. Home Depot, 2,300 warehouse store formats, 30,000 products in store. Okay, Home Depot. You want to buy the entire company right now in the market, $311 billion. PE ratio, 26.5. X marks the spot right there. Okay? 11.4% profit margin though, check mark. Gross margin of 34%, pretty solid. Not bad. I like it so far. One thing I will say, what was I going to say? 2% dividend as well. Okay? So it's paying a pretty decent dividend, and they're increasing it even though the market fell recently, with a lot of companies use that as an excuse to not pay dividends.
Pillar number 3 is revenue growth. Revenue growth over the past 5 years.
88.5, 94.6, 100.9, 108, 110, check mark.
How about profit growth over the last 5 years?
Go down here, Tim. 7, 8, 8.6, 11.1, 11.2. Very consistent.
Wow.
Okay, number of shares outstanding. You guys
Pillar number 5, shares going down, we want.
ready? 1.27, 1.22, 1.17, 1.13, 1.09. All right, we got another check mark here. What is that? 3 checks and 1 X?
Yes.
I didn't know we were doing Home Depot.
He's not ready for it. Okay, pillar number 6 is current assets greater than...
Fire, Gio. That was here.
Current assets over liabilities.
All right, 31.3 billion in current assets and inventory, and current liabilities of 24.2. So another check mark, kids. Another check mark. So we have 4 checks, 1 X.
Free cash flow growth.
This is doing good.
This is doing well. This is the big one for me. Everybody lives.
To answer some questions, we love the likes, guys. Paul always talks about what he's buying. He can wrap up today with what he's buying.
Oh, that's
and Llewellyn, we would show our portfolio holdings to show that we're not full of crap, of course.
Oh, I'm definitely full of crap, but the question is, am I going to show it? Of course I
How
will.
much crap?
Yeah, how much crap, exactly. Guys, 7.8, 8.1, 10.1, 10.6, 11.1, another check mark. Now for the biggest one.
Dun dun
The
dun.
ratio. 15.9, 16, 26, 36.6, 47.7 divided by 5 equals 9.6 times 20 equals 192 billion.
Oh.
What were they worth? What were they worth?
Like
311. Oh! Automatically, guys, I hate to say it, it's an automatic no buy for me. But the great news is, the second that this stock goes to where it was in March, I'm a buyer again. In early 2019, this is a company I'm buying at, actually not even that much. It needs to drop by 30%. So right now it's at 290. So 290 times 30% equals, what is that? 87 bucks. So basically $200 a share. $200 a share, I'm buying it.
And it got well below.
Well below that.
during the
Well
dip,
below
yeah.
that. This is great. Great numbers all around. The only thing we didn't like about it was the PE ratio, and that's what shows. The two most important parts, the PE ratio and the price of free cash flow, were too high. I'm buying at $200 a share.
Why times 20?
So,
Somebody asked.
great question. We talked about this, and pardon me, guys, the new people, I forget, sometimes we talk about things and I assume everybody remembers. When you have a very established company like this, you want to average the ups and downs. So you want to take the last 5 years, take the small ups and downs, take an average of them, and multiply 20. Usually I'd want less than 15 and even single digits at some point. But if you see some growth along the way and they're mature companies, it's good to take this average and multiply by 20. I don't want to get the numbers of it, but 20 seems a bit the number I go, okay, not bad. And if it fell 30% and the PE is 26, that would take it to about a 16 PE. And for an established company like this, at that point, our dividend would be 3% almost, 2.7%. I'd be like, you know what? I feel good about Home Depot. They can grow internationally. They can pay me a 3% dividend. They have stable and growing free cash flow. I love it. I love it under 200. Guys, don't look at 200 and think, oh my God, it's so far away. It's not so far away. Look, it was at 240 and fell to 165, 170 in a matter of a month. These things happen very, very quickly and aggressively.
Paul, have you changed your stance? People have always asked, what is Paul actually buying? In our past videos, if you look on YouTube, we've gone over Carnival Cruise, which Paul loves. It's down, it's in the
I
tank.
bought some more.
More.
Yeah, today.
We love jets and airlines, obviously, they're coming back. But I just read an article by our friend Meet Kevin on YouTube.
Yeah.
And he said to stay away from cruises and airlines because they're going to be in a tank even more if a second wave hits. What is your stance on those two industries?
He's absolutely right. If a second wave hits and they shut down again, airlines and cruise lines will be shattered. I am banking on the fact that the United States government has learned the lesson that shutting down the economy was not the right thing to do. Is it going to hurt? I still think the Carnival Cruise Line is the best cruise to buy, and they have 11 months of cash sitting in, 11 months of negative cash flow sitting there, ready to go. Could I be wrong? Absolutely. But my job is to make bets on 20, 30, 40 companies at a time and be right, be really, really right on 20% of them, be really, really wrong on 20% of them, and be average right on the other ones. I'm not going to be, if I'm right 50% of the time, I'm going to make a lot of money. If you're right 50% of the time, you're going to make a lot of money. I feel comfortable understanding their financials, saying, Meet Kevin could be right, but I don't think Meet Kevin probably knows how much money that Carnival Cruise Line has sitting in the coffers, how much they're losing every single month. It's just a different strategy. I'm fine with that.
The CDC, an astonishing news article yesterday I read is they advise not to shut down again. That is their advice, is that we just don't need to do that again.
I think the Who said it too.
Yeah, so it's
Oh, did
probably
they?
not
Yeah,
going to happen.
Who said it?
Okay, Paul, I have to get cooking here. Do you want to do Walgreens with Gio?
Let's do Walgreens and Geo.
He's got his, Gio, pop up Walgreens and see what you got here while
Okay.
Paul pulls it up. Guys, I love you. I love our followers. Thanks for the comments. We will see you you'll see me again Tuesday at 11 Eastern. And next week we're going to be live streaming twice. As always, we're releasing our new videos. So thanks for the likes. Share this with someone who would want to argue about Paul with this. And
Argue with Paul about
argue with Paul about this. So, all right, we're going to hit Walgreens. Paul, go through it, baby. Tell me all about it. Go ahead,
Stephanie.
Gio. See you guys. Love you.
Gio, you want to sit over here? All right, come over here. What is this? Is it a Twizzler piece right here? This is disgusting.
Oh yeah, love you.
That was me. All right.
That's awesome, Gio.
So
Yeah.
Gio, Walgreens currently their market cap is $32 billion. So that means if you want to buy the entire company in full, you're gonna pay $32 billion, right? Okay, what's their PE?
45.
Yeah, it's pretty high, isn't it?
Yeah, when I saw 45, I said immediately Paul's not gonna like this.
That's a good catch, but we'll see when it goes forward. Okay, guys, they've clearly taken some hit because their profit margin is negative right now. In the last 12 months, their profit margin is 0.5%. Is that even 0.5%? It's terrible. So 2X's to start. Yeah, but there's probably a reason for that. A big company like Walgreens shouldn't have this. So we're going to compare this to CVS and see which one you should buy. But if you guys look at the chart here, look at Walgreens. At the end of 18, it was at $83, $84 a share. This is a prime example. If I told you at the end of 19 that I want to buy Walgreens at 40 bucks, you said, no, that's not going to happen. Look where it is right now, $37. So let's go to their growth, their revenue growth, kids. So let's make sure it connects. 103, 117, 118, 131, 136. Probably an acquisition happened here to see a big jump for such a big company. Okay, now profit. That's a check mark. Profit, 4.2, 4.1, 4.0, 5.0, 3.98. X, it was increasing, sort of, and then decreasing, it's an X. Number of shares outstanding, children, number of shares outstanding over the last 5 years. 1.04, 1.08, 107.4, 991, 921. Check mark. Started to go up a little bit and then fell back down. So they're using their cash to buy back shares. So how many checks do we have now?
2.
That's not true. Really? How many X's?
3.
Wow, you're right. You're right, because the profit, you're right. Oh my Lord. I am right. Total current assets, 18.3 billion. Total current liabilities, 26.6. What does that mean? X, another X. They don't have enough cash and inventory to pay off their current liabilities, which is a very common thing in retail. But now for the most important ones, free cash flow, growth. All right, you ready?
Mm-hmm.
Okay, 4.4, 6.5, 5.9, 6.9, 3.8. Okay, this one's technically an X, but it had some growth and then fell. So it's technically an X. Let's see what the average is here.
Still at 2 checks.
10.9,
Only 2 checks.
10.9, 16.8, 23.7, 26.5 divided by 5 equals 5.23, let's call it 5.3.
Yeah.
Times 20 equals 100 billion. It's definitely less than 100 billion. $32 billion. Guys, this is one of the rare exceptions. I would look at this company if I were you. Here is why. The PE is based on the last 12 months, right? But you can't go off that because something happened in the financials here that made the company lose a lot of money in the last year. So what you want to do is you want to understand what was caused that big drop in profit. And it was probably some one-time expense. Actually, Walgreens, I think, is the better buy. So here's exactly my point, guys. And everybody, yes, exactly. Isn't that amazing? Everybody's going to look at me and go, what? Why? It's selling for 45 times profit. But the reason why it's selling for such a terrible number is something happened here that caused them to not make as much money, and their free cash flow was very, very good. They're currently selling for 6 or 7 times free cash flow. So if you do more research and think to yourself, I think Walgreens will be around. They have 19,000 locations in 50 states and 25 countries.
Wow.
Yes, they're huge. I'm actually going to look at Walgreens myself now because I would have been turned off by the 45 initially. But when you look at the 8 pillars, and how many X's do we have here?
5, maybe 6.
Yeah, I think it was 6. We only had 2 check marks. So what am I saying now? This is exactly what I mean, guys, when I'm saying it's not just me being negative. You have to understand the whole picture and say, wait a second, they didn't make as much money as they used to in the last 1 year. In the trailing 12 months, something happened. So your job is to go figure out what happened. Is it a one-time event that they're going to get through? And if the answer is yes, I'd be buying shares right now.
The forward P is 7. How?
The forward PE?
Yeah.
They estimate what the forward earnings would be, and they say, okay, it's 7 times. Now, I don't really look at forward earnings. On a company like Walgreens, it's probably okay. Most people exaggerate the forward earnings. They tend to not be very accurate, but that's a good example to bring up like, hey, if they're selling for 7 times forward PE, that one time they lost some money. Something happened here in the last. Let's look it up.
Someone said, doctors' offices and things closed, not taking patients, more people
Then
going
why
to
does
the
CVS
stores.
What about CVS though?
Yeah,
CVS
sure.
didn't have an issue,
CVS is opening up to do testing.
and they're killing it, aren't they?
Yeah.
So something happened here in the quarter. Let's look what happened in these quarters.
Crying out, my mom.
Okay, so look at this, guys. Couple things. Operating income was a big drop from 1.2 billion to negative 1.8.
Well, that's big.
Income from continuing operation, yeah. So they had. They had a big increase in their sales. Okay, look at this, guys. This is their last 10 quarters. So this is their SG&A expense. This is like their cost of business sales, general administrative expense. 6.3, 6.2, 6.2, 6.2, 6.3, 6.2, 6.4, 6.2, 6.3. See a pattern there? Now look. Increased by
Whoa.
$2 billion from one quarter, in one quarter,
That's
guys.
insane.
So something happened. You have to go research. Why did their SG&A expense go up by $2 billion?
Is that testing?
I don't know what the reason could be.
I have a quick question.
Let's hear it, Gio.
So, why is it that on some of the some stocks and it's an X you don't buy, but when it's Walgreens, why is this now a buy? And other
I'm not saying
stocks
it's a buy for sure. We have to understand why this number jumped up. Because just like everything, let me ask you a question. If you took a test in school and you had just come home from a trip, you weren't to school all week, you weren't able to study, and you got an F, are you an F student?
No,
Why'd you get the F?
because you weren't studying.
Correct. So the next test, if you study, are you going to get better than an F?
Yes.
Okay, same thing here. Something happened here that was equivalent of you not studying, being on a trip, not having anything to do with school, not learning anything. You got an F. But I'm not sitting there saying that's an F. I would be concerned if every single test you had an F, and I go, well, Gio's just an F student.
Yeah.
Do you see what I'm saying?
Yeah.
So that's why I sit there and say the 8 pillars. I'm getting a nod from Tim, like that was a good analogy. The 8 pillars are about looking at the whole picture. And even when you look at the whole picture, you still have to ask more questions. Everybody thinks I'm anal, but the average person would have said no to this company. And I'm sitting there going like, actually, if I think Walgreens is going to be around for a long time, and I think they're going to turn, and I think this is explainable, I'm buying Walgreens all day. In fact, I think Mo's watching. Mo, let's look at Walgreens here and understand why this $8.2 billion expense happened in the
Tell
last
us,
quarter.
Mo.
Yeah, Mo, tell us.
Tell us. Mom.
So,
Tell us, Mo.
do we have any questions on there?
No, just some comments going back and forth.
So just because there's a lot of stocks we do, and I've been noticing a lot of them aren't checks, does that mean there's not a lot of good stocks to buy?
Well, it depends which ratio you're looking at. Some of the check marks have to do things that have nothing to do with the stock market, and some of them do. The 2 most important ones to me are PE, price to earnings ratio, and price to free cash flow. Those are the 2 most important to me. Those depend on where the stock price is selling. The other ones are the health of the company. How's the company doing? Forget about the stock price. Are they able to increase revenue, increase profit, increase cash flow? So it all depends on what metric you're using. That's why the 8 pillars are so good. It looks at both market reaction as well as company, how they're performing.
Good deal. Mo said he's looking. Laren, what's your question? He said he had a question. What was your question, Laren?
Is he typing right now?
We'll give him a second to type, and as soon as I see it, I'll try to read it off quick.
All right, cool.
Oh, he said above. Laren, I can't see it above. Sorry. Unless, Paul, you can connect
You guys
and
like
look.
and subscribe. What was that?
Yeah, definitely like and subscribe.
Like-
I can't go back and see the comments since we're streaming from an iPhone here.
Yeah, can you just run it again, Larry?
So just write it again, copy, paste it, Laren, and we'll try to catch it this time.
Yeah, sorry about that. Because we're on the iPhone here now. I think it's a good rebound from.
That's what we had to do.
Yeah.
He said, are there some stocks that you plan on holding more or less indefinitely? Uh-oh. Some people just started commenting like crazy, and I just lost all of it. Okay, here we go. He said there are some stocks that you plan on holding more or less indefinitely. Buffett style and Coca-Cola trying to take advantage of long-term dividend appreciation. Thanks,
So,
guys.
That's a great question, and let me let me kind of, so,
Ooh, we should exit.
let's say I have a stock that I think is worth this. So
But-
over time,
Ben said this was his idea on the Home Depot, by the way.
what's that? Buy and hold for a long
yeah.
time?
Yeah, he's expensive, but he's holding it forever.
Good. So, it all depends on where you are in your portfolio. For you guys out there, it's probably a good idea to buy and save. My job is to put my money towards better value plays. If I think a stock is worth this over the next 10 years, if it's selling here, what am I doing? I'm buying it. If it's selling here, I probably won't sell it. Buying it. Now, if it goes to here, this is a big gap between price and value. Now, at the same time, I find another company where here's the value and it's selling for here at the exact same time. What I'm going to do personally, I'm selling this to buy this. Because what are the chances of this going all the way up here? A lot less than this one going up to here. And that's my goal as a value investor. Warren Buffett's a value investor, and if you look at his earlier stuff before the 1990s, he bought and sold as the price value got to where he wanted to go. In the 80s and 90s, he changed his mentality because he had so much money that he had to buy good companies and hold on to them forever. Because they would do well over long periods of time. And because when you have so much money that you can't invest in all these small companies, he has to be invested in good companies for long periods of time.
I think the one gentleman had a question about why a PE of 20, which I think you answered. I was always told 15 unless PE growth was greater than 15, then you can use
Great
P/E
question.
equals growth.
Yeah, PE ratio growth, the price to earnings growth ratio is a good ratio to look at. I picked 20 because I'm doing an average of the last 5 years on PE, I do 20 because I want to see, to me 20, from 15 to 20, a company can grow into that value. Do I want to see 15 or less? Absolutely. But also what matters to me is, does the company have growth potential to justify that? Also, I believe the more established safe companies should get a higher PE because it's kind of like buying government debt. You're less likely to have problems with it, so pay a premium for it to get more of the consistency. That's my opinion on it. I'm not saying I'm right, I'm not saying I'm wrong. 15 is the historical average for stocks, 15 to 16, but it's all depending on what you want to do. If you find a good company with good cash flow. The other thing is I like the price of free cash flow number way more than the PE number, but that's just my opinion.
Good deal.
All right, guys, thanks again. Think about the Patreon thing. Think about everything. We're gonna start advertising it soon to you guys in the live chats. And then thanks for being very patient with us on this live
Like
stream.
and subscribe.
Yeah, because Gio needs to go to high school, and he's going to go to a really rich private high school, right, Gio?
Sure.
Okay. All right, guys, thanks very much, and we'll talk to you later.